Dividend increases are the most rewarding aspect of dividend investing. It's extra income that comes easily, requiring no additional effort from you. With continued increases year after year, your dividend earnings will grow at an accelerated pace without the need to invest new capital. This is the power of dividend growth. Countless companies are increasing their dividend every year, and today we will focus on 9 of them that have recently done it. I will show you what their fair value is and will share with you my opinion about all of them. But remember, this is not an investing advice. You must do your own research before investing in anything. The first one is Home Depot. Home Depot increased its dividend from $2.09 to $2.25, an increase of 7.66%. The company has increased its dividend for 14 consecutive years and now pays $9 a year in dividends, which represents a dividend yield of 2.42%. The dividend is growing at a rapid pace, and the 5-year average dividend growth rate is 8.94%. With a payout ratio of 58%, Home Depot has the potential to continue increasing the dividend at the same pace. The 5-year average dividend yield is 2.3%, which is slightly lower than the yield at the moment. Analysts give the company a moderate buy rating, with a 3.1% downside, but this is due to the slowed down customer spending for home renovations at the moment. It is expected spending to grow up when interest rates start to go down. Analysts also project earnings per share to grow up by 8.55%. The fair value of the company is $353.72 a share, which is 5.2% lower than the current price. I remember that fair value shows what is the fair value according to several factors, but this doesn't mean that the share price will go lower. The market is unpredictable and irrational. It is more dependent on rumors and expectations than on facts. I like Home Depot stock, but we'll wait a little to see where the economy is going. It's a good company, but there are way better opportunities in the market right now. The next one is Analog Devices. Analog Devices has increased its dividend for 20 years in a row. The dividend was increased from 86 cents a share to 92 cents a share, which is an increase of 6.98%. The increase is smaller in comparison with the recent ones, and you can see that this is the case for most of the companies this year, because they are more careful with their spending in this uncertain economy at the moment. The company has a dividend yield of 1.92%, which is slightly higher than the 5-year average dividend yield of 1.83%. The payout ratio is 56%, and the 5-year average dividend growth rate is 9.45%. Analysts are giving the company a moderate buy rating with a 7.8% upside potential and an amazing 23.41% projected earnings per share growth. Insiders are selling the stock, but expect this, everything else looks great for Analog Devices. The fair value of the shares is $190.11, which is 19.6% lower than the current price. If analysts are right with their projected earnings growth, then this company is definitely a buy. But the fair value suggests that the share price will drop. I will pass out Analog Devices for now, and we will see what will happen in the future. American Homes for Rent also increased its dividend last week. This marks its 4th consecutive year of dividend increases, and the dividend goes up from 22 cents to 26 cents a share, which is an increase of 18.18%. As you can see, the company is growing its dividend as fast as it can, from 10 cents at the beginning of 2021 to 26 cents today, just 3 years later. This gives the company a 5-year average dividend growth rate of 69.24%, which is really impressive, as I just mentioned. The dividend yield at the moment is 2.99%, and the annual dividend is $1.04 a share. Analysts give the company a moderate buy rating with 7.9% upside potential and projected earnings per share growth of 6.63%. Insiders are buying shares, which is a good sign. In my last video, I reviewed 3 high-quality REITs, and in all of them insiders were selling stocks. For American homes for rent, my valuation method is not working, so I believe that analysts are right with their predictions. This REIT is one that I am thinking of buying, and maybe now is a good time to do it. I can't see anything concerning about the company, and like most REITs, I expect this one to go up in value once the Fed starts to lower the interest rates. Xcel Energy also increased its dividend last week. This marks its 21st year of dividend increases. The dividend was increased from 52 cents a share to 54.75 cents a share, which is an increase of 5.29%. The dividend yield at the moment is 3.51%, which is way higher than the 5-year average of 2.75%. In most cases, if there isn't something fundamental changed about the company, this is a sign that the company is trading at a discount. Analysts are giving the company a 9.2% upside potential for the share price and a hold rating. They also project earnings per share to grow 7.56%. Insiders haven't traded shares recently. The fair value of the shares is $50.82 a share, which is 16.7% lower than the current price. I am not so familiar with this company. It looks promising, and maybe I will take a closer look at it when I have some free time. The next company in my list is Garmin. It increased its dividend for 7 consecutive years. The last increase was from 73 cents to 75 cents a share, which is an increase of 2.74%. Here again, you can see that the last increase is lower than the previous ones. The 5-year average dividend growth rate is 5.16%. The payout ratio is safe at 55%. The dividend yield is 2.24%, a little higher than the 5-year average of 2.44%. Analysts give the company a hold rating with a downside of 3.4%, but project its earnings to grow by 8.52%. And here insiders are selling shares of the company. The fair value of the company is $106.53 a share, which is 27.2% lower than the current share price. Garmin is one of the leaders in its niche, but at the moment the company is not looking like a good investment to me. If it drops to its fair value, maybe I will buy it. Essex Property Trust also increased its dividend last week. This marks its 30th consecutive year of dividend increases, which is an impressive achievement, especially for a REIT. The increase was from $2.31 to $2.45 a share, which is an increase of 6.06%. The dividend yield at the moment is 4.02%, which is higher than the 5-year average of 3.21%. And the 5-year average dividend growth rate is 3.48%. Analysts give the stock a hold rating and expect its price to go up 6.2%. They also project its earnings per share to go up 3.64%. The valuation model is also not working with Essex Property Trust, so we need to evaluate the share price by ourselves. Essex is one of the stocks that I want to add to my portfolio. But at the moment, I think that there are better opportunities in the REIT sector, and I prefer to invest in some more undervalued ones like American Tower and Realty Income. Another REIT increased its dividend last week, and this is Prologis. It increased its dividend from 87 cents to 96 cents a share, which is an increase of 10.34%, marking its 11th year of consecutive dividend increases. The company has a 5-year average dividend growth rate of 10.87%, which is really good, especially for a REIT. The dividend yield at the moment is 2.61%, and the 5-year average dividend yield is 2.32%, which suggests undervaluation. Analysts give the company a moderate buy rating and an upside potential of 5.9%. They also expect earnings to grow by 12.18%, which sounds amazing. Insiders are selling the stock, but as I mentioned, this is seen in the most REITs at the moment. The fair value is $143.60 a share, which suggests that the share price is 7.2% undervalued. As you can guess, I'm a big fan of the REIT stocks. And yes, I think of adding projects to my portfolio, and maybe now is a good time to do it. The next time I contribute money to my portfolio, I will look closer at it and maybe buy some more shares. L3 Harris is the next company on my list that increased its dividend last week. The increase, marking its 23rd consecutive year of increases, was minor. The company increased its dividend from $1.40 to $1.60 a share, which is an increase of 1.75%, which is way lower than their usual increases, as you can see looking at its 5-year average dividend growth rate, which is standing at 10.01% at the moment. The dividend yield is 2.14% and is a little higher than the 5-year average of 1.85%. The payout ratio is 59%, which is considered safe and is leaving room for future dividend increases. Analysts give the company a moderate buy rating with an upside potential of 6.2%. They also project the earnings per share to grow at a rapid pace of 11.23%. Insiders of this company are also selling the stock. The fair value of the stock is $221.09 a share, which is 3% higher than the current price. I like the usual pace at which the company is growing its dividend, but for the moment I am not thinking of adding it to my portfolio. There are some short-term obstacles in front of the company that it needs to manage before it catches my attention. The last company that I will mention today is Allstate Corporation. It has increased its dividend for 13 consecutive years, and the last increase was from 89 cents to 92 cents a share, which is an increase of 3.37%. Here again, we see a way lower dividend increase than the 5-year average of 19.86%. The dividend yield is 2.22% and is higher than the 5-year average of 2.36%. I am the type of investor who dislikes to buy a company when its dividend yield is lower than its 5-year average. Of course, there are exceptions for some fast-growing companies that are growing also their dividends. Analysts give the company a moderate buy rating with a downside of 0.7%. They also project an impressive 27.5% earnings per share growth. The fair value is $170.59, which shows that the shares are 6.7% undervalued. Allstate Corporation is one of the companies that I'm not so familiar with, and I'm not planning to add it to my portfolio at this point. However, I think that it looks promising. In conclusion, I love dividend increases, but they are not everything. We must look at the bigger picture, where price appreciation plays a huge role. Watch this video to see 3 REITs that are undervalued at the moment. See you soon!